Yeah, and Lyft. I'm checking SolarEdge right now.
All right, YouTube is up. Well, hello everybody joining us and who's watching this on a replay. I just thought I'd give a little bit of a background on what we're trying to do here. So I'm here with Jason Hall of The Smattering. My name is Travis Hoium, and I write the Rive Project, write for The Motley Fool, and I'm here on YouTube at Rive, R-I-I-V. And we just want to give our instant reactions to earnings as they're happening. I think this is really interesting to go through. I tend to not look at what analysts are looking for with the stock. And so I try to come at these completely fresh from that perspective. And so I think it's fun to look at these with somebody else and see what our reactions are, because maybe sometimes they're a little bit different. Jason, what's your process for looking at earnings as we kind of wait for these numbers to come out?
Hey, Travis. Yeah, it's, and I've talked about this on the Smattering on our podcast that we do. I generally don't look at earnings right at earnings. It's very rare that I do what we're doing now, but I know, and part of that's because it helps me like anchor to thinking long term and not getting caught up with the momentum and what the volatility with the market and that sort of thing. But I know there's a lot of people that are looking at earnings in real time and they want to know, like, you get off work, you've got some stocks in your portfolio that represent a material part of your invested wealth, and you want to know what's going on with those companies, right? So I do think that we can help bridge that gap between thinking long term and acting in your own best interest, but also knowing what's going on with those companies pretty quickly. Travis, the other thing I think is really interesting too is, like you were talking about, is same as you. I don't look at like what the sell side analysts are saying. Generally, because I think it's largely noise. Their job's not really to predict which direction the stock's going to go with any precision. Their job is about creating access for the clients of the investment banks that they work for, right?
Right.
To grow the relationships that their banks have with those clients. Not necessarily, I mean, this is free stuff they're putting out there. I can promise you that, you follow the money, and the free stuff they put out there to create buzz and to get some name cred is not, that's not what their job is. So I know there's three stocks that we wanted to talk about first, Travis. We talked about Activision Blizzard, Lyft, and SolarEdge. All three have reported. We got the financial results for all three. Their press releases anyway. Where are we starting?
Well, do you want to start with Activision Blizzard? Let me pull up a little slide I put together to just sort of put these numbers into context, because I think then we can talk about what the numbers actually look like as I try to share things here. Give me a second.
Yeah, I think it's important to remember while you're pulling that up, Travis. I'll point out, most everybody that's watching this should know Activision Blizzard has agreed to be acquired by Microsoft. Shareholder approval has happened. At this point, they're working through regulatory approval, and it's not just U.S. regulators, because these are two very international businesses. There are regulators in other countries, and by and large, what they're looking at is how this would affect consumers, right? I think that's the biggest thing, because we've seen a massive amount of consolidation in the video game space over the past couple of years. So as much as anything, we're going to talk about the revenue and the numbers. As much as anything, investors are going to want to know what management is saying about that acquisition.
Yeah, and they're not doing a conference call. So this will just be the press release. But I do think that the reason that this is interesting is partly from Microsoft's side, because they have agreed to acquire this company that seems to be pushing forward. So, but it's $95 a share is the number that they agreed to acquire Activision Blizzard at. I believe the stock is trading at close to 70 right now. So there's a big disconnect between what the market thinks the likelihood of this closing is and what what the actual closing price would be. Now, when the deal was first announced, it was like summer 2023 they expected the deal to close. I don't know if we're kind of still on that timeline, but the reason to think about this if you're an Activision Blizzard investor is if the deal does not close, you are left with the business. So
Right.
what does the business look like? Here is the Q2 2022, so last quarter numbers compared to Q2 2021. You can see that during kind of the depths of the pandemic, things were pretty good. Margins are great. Net income's great. Last quarter, not so great. There was a bunch of different things that happened there, some delays with some of their games. So this is the context that I want to bring to this specific earnings report, because I think the thing that's really hard is if you're just thinking that it's an arbitrage game, then there's a ton of upside. But what if the deal doesn't close? Does this stock go to 20? It's worth thinking about.
Yeah, I'm going to share. This is where we are. So the deal was announced early this year, right? The price skyrocketed, right? Skyrocketed into the 80s. It was it 97 and change? It's the deal price, roughly 97 and change in cash. And it's typical when these deals announce, especially one like this that's so far out that it's going to take before it closed, that there's going to be some arbitrage, right? The market's not going to fully value it immediately. But you can see it never, even from the beginning, it never fully expected that the deal was going to get done. And what I've started to do is think about this almost like the dollar number is like the percentage of it getting done. So the dollar number minus 20. So 71% minus 20. So I think it's still 50-50 that it gets done. And the market tends to agree. The one thing I don't see, Travis, is I think the reality is that there is significant concern that this is going to affect consumers in a negative way, right? Microsoft's game is obvious. They've already started a service, right? They have a monthly subscription for video games. They want Activision's content to be part of that. And that's obvious. There's no doubt about it. You don't buy one of the largest video game makers on the planet and have a monthly service without wanting to include that as part of it. But the question, what it gets back to is going to be exclusivity, right?
Yeah. Do you want to start with the numbers?
Let's see here. All right. So, yeah. So I'm going to hit it right here at the top. GAAP net revenues. I can share this. Get on the left here. This is this quarter. This is the year ago quarter. 1.8 billion in revenue compared to about 2.1 billion a year ago. So you've seen a substantial reduction.
Yep.
Earnings 82 cents a share down to 55 cents a share. And again, adjusting that. So still a pretty significant decline. Now, one of the things I think is important is people maybe don't always necessarily think about these video game companies as being somewhat cyclical because it's tied to releases of their big tentpole games. Whenever they have the newest release of those big games, that usually means it's going to be a great quarter and a pretty good year. It's become a little bit less that because they have they bought King.
A lot more recurring revenue. Yeah.
Right. That recurring revenue, but it's obvious that this is still going to be a cyclical business, and they're in kind of one of those in between periods with their biggest releases, right?
They are. And the other thing that I have to question is, what is the future of a studio like this? And I think this was always one of the challenges with Microsoft's strategy. The part of the appeal of a subscription is now we're going to pull in a whole bunch of titles. We don't need to be reliant on one big tentpole, or in the case of Activision Blizzard, there's 3. Now we can ride the waves depending on where the popularity of games go, but yet you're buying a studio that's reliant on those tent poles and has a very different business model. And I wonder, coming out of the pandemic too, does consumer behavior change? We've seen that with something like Roblox, right? Like,
yeah,
turns out when kids go back to school, they're not playing Roblox as much. Who'd have thunk? And gaming has always been.
The rest of us aren't playing, the silly little freemium games on our mobile devices as much.
Yeah, Absolutely. And
Travis, here's a bright spot. I got a bright spot for you from the release.
okay.
Bookings is important, right? Because so
Yep.
bookings is the total value of sales that customers agreed to, that actually they paid for. And the difference between bookings and revenue is what you can recognize because it's what you actually delivered. So for example, using like World of Warcraft or uh, what's the Modern Warfare, like the Call of Duty games.
Call of Duty. Yep.
Somebody you buy a game, and then those games now have so much of an online experience, and you might buy like expansion packs too, like you get the big bundle all at once. They'll recognize a big chunk of that revenue up front. Those expansion packs, those additions, they can't recognize that revenue until they release that part of the product. And then again, too, like that initial hit for the game itself, they don't recognize all of that revenue up front either because so much more of it has become part of an online game experience. So even that revenue recognition gets stretched out, say, over multiple quarters or a year. Bookings is all of the dollars that people paid for games in that particular period, even the stuff that's not going to be recognized as revenue until future quarters. So again, that revenue number was $1.36 billion compared to 1.2 billion in the third quarter. So that's a positive that there's starting to be a little bit of a turn from the cycle, and it's starting to generate, because again, those bookings today, that's future revenue, right? So that's a positive that number's larger right now.
Let me ask you a question, Jason, because this is kind of the crux of it in my mind. If you are an investor in Activision Blizzard, do you look at these numbers and do you want to own this business if the Microsoft deal falls through?
No, I don't. I certainly would not want to own it. I mean, 70 is a lot more attractive than it was, even, a few months ago. But I mean, just look at what's happened at every other standalone publicly traded gaming stock. Look at Take
Right.
Two, EA, across the board. They've all come down substantially with the market, broadly with the market, right? Because this is the discretionary thing. This is a bucket of money when people can spend it when they have it to spend and they want to spend it. If we go into recession, gaming can do okay, right? It can do well because people tend to spend more on like things like this when times are tougher because they want to be distracted from their real problems.
Yeah, absolutely.
But the biggest issue with me, Travis, is that the entire gaming industry has become very mature. It's a very mature industry. It's lower growth. The reason we're seeing deals like this deal that Microsoft agreed to buy for is bigger companies are trying to consolidate it, and they're trying to make it part of some bigger offering they have to make an ecosystem, right? Apple's kind of shown a lot of companies the way to do that effectively, and Microsoft, to a certain extent, is trying to do the same thing with gaming. So I'm not interested in it because the growth profile doesn't. I don't think it's very attractive, and it's hard to say what the trends are going to be. And I think by and large, these assets are going to continue to be devalued a little bit.
The other thing I'll add to that is I think you're absolutely right. The way that I think about this market, if you kind of think about developers on a continuum, there's small developers who are making little indie games, putting them on smartphones, maybe even on Nintendo Switch. Then there's the big developers doing Fortnite and Call of Duty. And what Microsoft is trying to do is consolidate a lot of that with their subscription bundle. Because remember, the subscription isn't just for Xbox; it's for anywhere you want to use the Microsoft Game Pass subscription.
Right.
So that's what they're trying to do, is have as much content on there as they can. So they're trying to be the aggregator on that side
Across all of the platforms.
across all platforms. And then there's still going to be these indies. And I look at numbers like this, and if you're stuck in the middle, if you're Take Two, if you're EA Gaming, Electronic Arts, what do you do? Do you just become the company that makes games and then sells them, puts them on Microsoft's subscription service, and then you sort of lose control of the customer relationship and with the ecosystem and the data and all that stuff? That's what worries me about Activision Blizzard. If you're a shareholder and this Microsoft deal doesn't go through, is that they then become a company that's in a really hard spot So that basket of stocks, EA, Activision Blizzard, and Take-Two, I think they're really tough to invest in right now because I don't see value. You're seeing revenue go in the wrong direction.
Well, pricing power has eroded, right? And it's going to be tough to have the kind of margin profiles we've seen in the past if your access to, because once upon a time your product went in a Best Buy or a Circuit City or another large retailer, a GameStop, and when that funnel is being shifted away from retail customers willing to pay that sticker price or even go to your website and pay that sticker price to buy the game to that fixed monthly cost, and then that becomes the market, it resets the math.
Right. So what do you think? Activision Blizzard, okay results, bad results, good results. Where's your head at?
I think they're fine, and I think there's good stuff, right? Because the new Call of Duty game's done really well. It's been a big hit. We see that in the bookings, right? So eventually that's going to carry through. But again, the business has just gotten so large. If that deal doesn't go through, I tell you, man, it's hard to say. If you were a shareholder in this business and you were holding, waiting for that 95, it's hard to say, okay, you know what, just sell and take 71. Because I really do think that the odds are better than even that it gets done.
I agree. But I think the problem is if it doesn't get done, this stock goes to 20, 25.
I don't know. I don't know if it goes that far. I would. Here's how the best way to think about it, because I have some other stocks that I've lost conviction in, that I've sold, that are down big, and I'm doing it now because there are other stocks that I have high conviction in that are also down big.
Yep.
So if you have some really good ideas right now, and you're looking for capital to deploy, taking the $71 a share for Activision might be the best thing to do. It's really hard to predict a path forward for just great returns. It just really, yeah, that's kind of how I think about it.
All right. Well, there's our initial thoughts on Activision Blizzard. I see the business moving in the wrong direction. So this is one I'm staying out of. Let's move over to SolarEdge. I will again bring up the numbers for last quarter, and the growth has been outstanding. 51% last quarter. Gross margins were a little bit down. They're seeing a little bit of pricing pressure, commodities and things like that, a little bit harder to ship things around the world. So some of that stuff will ease over time, but the numbers have been just phenomenal. So did this continue, Jason?
Here's their slide with that info and a lot more. So revenue, $837 million. The solar segment continued to generate the majority of that, but strong $48 million in non-solar segment, right? And SolarEdge they're diversifying. They're getting into like EV powertrains, storage. They have their power backup for like industrial applications, things that they're doing. So they are diversifying that. But again, the solar based, all of those panel level electronics continue to drive the business. Gross margins look like they got held relatively steady on a GAAP basis, 26.5%, maybe down a touch.
Yeah, that's down from where they've been historically.
Oh, well down from that 32 to 39% we saw in last year and prior.
Yep.
But compared to last year, it's still down a little bit. Let's see what else here. Net income.
So just to put the top line numbers into perspective, revenue up 59% from a year ago overall, and then 65% in the solar segment. So that there's not a lot to complain about there. The thing that I think is interesting with these numbers, and as we see what's going on in the solar industry right now, is the tailwinds from the Inflation Reduction Act are not going to hit for a while, for at least a couple of quarters. So there's potentially a lot of upside ahead.
This is revenue from before that was even a thing.
Yep.
And certainly not revenue generated because of it, because those things aren't doing anything yet, right?
Yeah, absolutely. Let's see what else. They had guidance for the fourth quarter revenue, $855 million to $885. That is a little bit up sequentially, but fourth quarter is going to be a little bit lighter because it is colder, at least up here in the north. little bit harder to install solar.
So I have a question for you. We saw gross margins peak at or close to 40% a few years ago, right? And they've come down. And I think you and I have largely agreed that this is basically a supplier kind of in between the customer
Mm-hmm.
and the manufacturer of the product that people are buying. And historically, these kind of businesses just don't get these kind of the margins that SolarEdge is getting.
And
And
Enphase is in the
considering,
same boat and similarly valued. Yep.
yeah, so considering how much revenues grew, and yeah, we know there's cost pressure, right? We know all of those things that are driving inflation are there. But are you not a little bit surprised that they're not able to start getting some sort of operating leverage?
I think that is surprising. What I'm looking for with this part of the solar supply chain is it's been really interesting to watch over the last 15 years where the solar panel itself was just completely commoditized. I mean, there's like no margin, there's no money to be made in being a solar panel manufacturer. That's maybe starting to change a little bit as you get to scale and there's many fewer competitors. The installation space is very competitive, and depending on how you look at it, maybe either slightly profitable or not profitable. But a lot of financial kind of shenanigans going on there as well. In the middle is this brains of the operation, which is the inverter turning the direct current from the solar panel into alternating current that you can actually use in a home or on the grid. The monitoring, if you are a small installer, you kind of have to choose what system are you going to use? What's your infrastructure? Is it going to be SolarEdge? Is it going to be Enphase? Are you going to be a SunPower partner or a Sunrun partner? And it's been surprising to me that everything else has been sort of crushed to a commodification level, and then this specific segment has remained both high growth and highly profitable.
Yeah.
And I just don't think that's going to continue forever. But that's been wrong, to be clear. For I thought that for 5 years, and that's been wrong. So I don't know. That's the way that I think about it. So I guess I'm not surprised to see margins come down, but I don't know if that's something that's going to sustain as well, just because of competition. What do you think, Jason?
Here's the slide that really compares that, right? That looks at this Q3, which is over here on the right, to Q3 2021 and last year, right? And again, we've seen gross margins from 2 years ago. This was not even close to the peak, right? Now the overall profile has changed, partly because they're getting less gross margins and some of those other things. That's why they report a couple of slides up. Let me see, right here, gross margin for solar segment 28.3, right? Because that's more comparable to like this number back in 2021. So I think that's important. But again, look at operating income of you know roughly 10% operating margin
Mm-hmm.
compared to 12% operating margin a couple years ago. And my question, and again, this is an instant reaction, so not having had time to really dig into the numbers and not sure how much of it they're going to fully disclose at the operating cost level, probably not really anything. How much of that erosion in operating margin is because of higher operating expenses in those newer businesses that they're trying to develop, where their operating margins might be low single digits or even negative at this point for some of those things, and they are getting operating leverage in the solar panels. Like it's defied gravity. I think that's about even though it's come down
Right.
some, it's defied gravity. And that's why, as much as this is one, frankly, from when I bought this company like 6 or 7 years ago, I've sold off a part of it multiple times, and it has continued to be like a meaningful little part of my portfolio, even though my cost basis at this point is like 0.1%.
Yeah.
Because not only has the business defied gravity in terms of what we usually see of those companies that are in the middle and are just a supplier, about like having pricing power and getting really good operating margin, but the fact that the stock has continued to defy gravity too. I haven't looked at it today. I don't know what it did today. I don't know what it's doing in after hours. But I can tell you it's remarkable how this business is done. I continue to say, this is my last thought on it, is that the reason that I do continue to hold is really because if they can continue to leverage the cash flow from that solar part of the business and build some meaningful other businesses in other areas that are complementary in what they do well, then it could continue to become a larger, more profitable business over time.
I'm going to pull up. I think what you're trying to point out here, and hopefully this chart will help people that are watching. This is SolarEdge's revenue. So I'll just isolate that here. Revenue growth has been incredible over the last decade. No questioning that. Net income growth starting to tail off here, but has been significantly growing since they were just coming out of net losses in, what was that, 2014, 15?
Right. Yeah. And in fairness, that
But then
last
their
one, we don't.
multiple has
Go
gone
ahead.
up as well.
Right. Right. Right.
This is
So
what makes me nervous
investors
is
have
this.
increasingly been willing to pay a higher premium for this business over time.
Yeah. And that's what makes me nervous, is that this is fundamentally a sort of commodity business. This is like electronics. Making electrical products is not a typically long-term a high growth, high margin business. This is a commodity business where the GEs and the ABBs and the Siemens live, and those aren't companies that you pay a high price to sales multiple for. So that's what makes me nervous about this stock, and that continues to hold true today.
Yeah, as much as technology is important and that innovation, and they've been a disruptor, right? They really have with their products. At the end of the day, it becomes about being a really good manufacturer, right? Riding the cycles, managing your capital well, and growing your operating leverage over time. Not getting 60% margins and carrying half of that over to the bottom line on the operating side.
Yeah, that's the trend that we're gonna have to watch. Is
Yep.
This should be a really great. This should be an improving operating point for them with the industry growing. If you can't generate leverage in this environment, then you're not going to be able to do it. And so that's something to keep an eye on. Final thoughts. What do you think? Good, bad, and different?
I continue to like the secular trends are very favorable. They're going to continue to be broadly the solar industry, the EVs, that part of their business, battery storage, all that kind of stuff. Continue to defy gravity, right? I am going to give them a benefit of the doubt right now that the pressures on margins and on their operating income are real supply chain challenges that every company that makes a thing and ships a thing are dealing with. I'm going to give them the benefit of the doubt, but at almost 5 times sales, it's I'll leave it at that.
But if that number keeps coming down, I get more and more interested every day.
Love the business, right? It's the
Absolutely.
valuation.
Absolutely. This has always been, the challenge has always been, is it too highly valued? So we will keep an eye on that. Let's move over to Lyft. This is a company that I don't write about often, but here's what we got going on. Last quarter, revenue was up 30% to almost $1 billion. Gross margins coming up. I think that was actually the year ago. It was the year before. It was 54.7%. So sorry about that error there. But then they're burning money like crazy. This is the same thing with Uber as well. Losses growing as you're growing the business. That's a tough spot to be in. So what do we have from Lyft?
All right, let's see here. I was hoping they'd have a presentation. I didn't see a presentation yet.
Q3 revenue, $1.05 billion. Net loss, $422 million compared to $99.7 million a year ago. My goodness.
Yep, substantial. Gross margin, gross profit increased slightly, increased 2%. Now again, revenue increased 22%. Gross profit dollars increased 2%, meaning gross margin came down. So revenue minus cost of goods sold, that's your gross profit dollars, that came down substantially. So that's a challenge. I want to see. I'm going to stop the share because I'm probably making some people dizzy. What I really want to look at, and I think it's so important in these businesses right now, is to look at their operating results and to look at a statement of cash flows. So I'm gonna go straight to that in this report here. So let's start here. Operating loss, net loss. 422 million, like Travis talked about, but it's a $290 million operating loss, right? And we've seen an acceleration of that year over year, and essentially about the same operating loss as it generated um, year over year for the first 3 quarters of the year, right? So that's important. Um, Again, the losses continue. Now let's talk about losses on a cash flows basis. This is really important. And again, lost the first 9 months of the year, lost $75.5 million a year ago. That's pushing $204 million this year, right? So continues to lose money. I'm going to move up here to the balance sheet, because if you're losing that much money, you need to know how much money Lyft has in the bank. Has the short-term investments here. This is basically cash equivalents like treasuries and things like that are ultra safe. So you're looking at $1.64 billion in cash, which is a substantial amount of cash. Now
So
let's
add
let's
in
figure
what they
out
have
working
on the in actual cash and equivalents. You're talking $1.8 billion.
about 1.8 billion, right? So let's figure out working capital. So that's current assets, meaning things that you can quickly turn into cash, minus current liabilities, which is stuff that you owe somebody money for in the next 4 quarters. And we've got 2.5 billion in current assets, $2.7 billion in current liabilities. Travis, correct me if I'm wrong, but they ain't got no working capital.
Yeah, they're in a tough spot. Insurance reserves 1.3 billion. Operating accrued and other liabilities 1.4 billion. One of the things I'm watching this quarter, especially in the tech space, is what's happening with operating expenses. Like, are you continuing to expand headcount as we clearly head into some sort of a recession, slowdown in growth, whatever it may be? They're okay. Research and development was similar to what it was a year ago. Operations and support up a little bit. You would maybe expect that as revenue grows. You got to have maybe a few more people supporting operations. Sales and marketing was up about, was that 15% though? General and administrative up pretty significantly, $293 million from $292 million a year ago. This is one of those businesses where you look at their numbers, and even just at a really high level, you kind of have to scratch your head and say, what do they need to do to make money? Like, right, they would have to raise their prices by 50% to get to break even.
I think this is important because you think about Lyft versus like Uber. And I think people a lot of times immediately just like, okay, well, one's Coke and one's Pepsi. Well, okay, PepsiCo also has all the Frito-Lay products, right?
Right.
And Uber also has like Uber Eats. It has these other channels,
makes more money on
driving
that.
revenue,
At least
and seem like they're generating really good operating margins too, right?
Mm-hmm.
I think that's important, right? Because you look at Lyft and what it's doing, and there's real questions about how does it. Can you grow into this? It doesn't seem like it. They just had their best quarter ever in terms of revenue, right? Sequential growth in riders, 6% growth year over year in riders, and the losses are compounding. And when your working capital is negative because you owe more in the next year than you have in current assets.
Well, and then you have the inflation piece of it, and there are multiple angles that can hurt Lyft. One, drivers could just demand more pay. If the cost of gasoline has come down a little bit, but it's still pretty elevated from a few years ago, so it's more costly to operate. Vehicles are expensive, interest rates are going up, so buying a new vehicle is going to be expensive. I know Uber has long had programs to help drivers buy vehicles or lease vehicles. Well, that vehicle suddenly becomes more expensive when the interest rate on the vehicle is 7, 8, 9%, as opposed to 2% or 0%, maybe like it was a year ago. So I just, again, my question is, can they increase? What happens to the business if you increase prices 50% or 100%? And that's the kind of
Right.
stress test I'm trying to think about more and more with a lot of these companies, because you're right. Fundamentally, there's no way that this business can survive as is. I think that's
Yeah,
just
I
the
mean
bottom line.
the math says they can't, right? And of course, there are other avenues to get capital, but in this environment, let's be honest, they're not going to be very shareholder friendly.
Mm-hmm.
And you would imagine that it's creditors want to keep this a going interest. And I'm not calling for, and I don't think you are, Travis, either, necessarily calling for Lyft to be filing bankruptcy anytime soon, but thinking
No,
about
but they've got to
thinking about where
figure.
its financial results are, thinking about where its cash flows are, thinking about where its balance sheet is, thinking about all of the material risks in the economy that could undermine its efforts to drive better margins. You know what I say, Travis? I put it in the too hard pile right now. I think there's too many questions and I can't figure out those answers. I'm not interested in Lyft because of those things.
Yeah, and I'm very interested in autonomous driving coming. Cruise just expanded where they're operating in the San Francisco Bay Area. They're expanding into Austin later this year. I think that's the future. Is not what are we going to have to pay drivers? It's there's no driver. And our cost is just specifically an operating cost, and we got to cover that. So I think they're in a tough position for a number of reasons long term.
Yeah, I think that's fair. I think that's fair, Travis. Okay, what's next? Are we going to wrap this up, or we got any more that we want to talk about?
That was all I had on the list. Anything else that's popped up in the last 30 minutes or so, 45 minutes since we jumped on?
I think those are the main ones I want to talk about. Now we got a busy week coming up.
Busy week. Tomorrow we're gonna be back same time, 3. Well, I guess I'm in the Central Time
You
Zone, so
flyover state
3:15,
people.
4:15 on the East. So we'll have a bunch of big reports. Remind me what they are tomorrow. Lemonade.
So we got Lemonade's coming up. Disney's reporting one day this week.
Yeah, I think that's Wednesday.
About those too. There's a lot going on. There's a ton. Redfin reports Wednesday, maybe Wednesday. Yeah, what Redfin reports Wednesday. So we'll probably be talking about that later this week. Definitely check back in because I'm going to be on here, Travis. We're both going to be doing this for
Plug Power, Lucid tomorrow.
Lucid, that's right.
Yep. Disney is tomorrow. So those are some of the ones that we will talk about tomorrow.
All right, looking forward to it, my friend.
All right, thank
you. Anybody watching too? You know where to find us on Twitter, Travis. You're at Travis Hoium, right?
At Travis Hoium on Twitter. On YouTube, I am at Rive, RIIV. Got a 4-letter YouTube handle. So
I'm at.
You can find me there.
That's rare. That's amazing. That's amazing. I am at. I'll just give you my Twitter. I'm at The Smattering. If you have other stocks that are going to be reporting this week you want to hear about, let us know. If they're in our wheelhouse, we'll add those to the list. So that'd be helpful. Travis, this was awesome, buddy.
Yeah, this is fun, and we will see you again tomorrow.